The U.S. annual inflation rate rose to the highest level since January. The latest CPI report shows that inflation at nearly 3%, slightly higher than expected. Joining us to discuss is Jeffrey Tucker, the founder and president of the Brownstone Institute and senior economics columnist for the Epoch Times. And we have Michael Busler, an economist and public policy analyst and professor of finance at Stockton University. So to start off, Michael, I'll go to you here. How significant in your mind is this uptick?
Not significant at all. So when President Trump entered office, the inflation rate was 2.9%. We did get it down to 2.4. August jumped up to 2.9. In September, we got it 3%. If you look at the number, though, the core rate has been going down. Most of that increase, now the core rate excludes energy prices. Much of that increase last month was due to two refineries in California that were shut down, and it pushed up energy prices. But as we know, energy prices have started to come down. OPEC has increased production starting in the month of September, so that'll put downward pressure on price. And the U.S. is producing more oil per day now than ever, mostly as a result of President Trump's drill baby drill policy. So I expect in the coming months to see that inflation number drop down significantly. President Trump says by the middle of next year, oil prices may be down as low as $50 a barrel. That'll translate into about $2.50 a gallon for gasoline. So any upward pressure on price from the tariffs will be more than offset by falling energy prices, and the overall CPI will continue to go down.
So, Jeffrey, Michael addressed my concerns, but maybe you can speak to it as well, because we're back to a three handle on inflation. Are we in an environment of slightly elevated inflation and a softening labor market as well?
I wish I was as confident as Michael. I'm not that worried about gas prices right now, and I agree that the Trump administration's policies on energy have been an improvement. I mean, a dramatic improvement, really, in gas prices and energy generally. So I'm not worried about energy prices driving it. What I'm really worried about is the general trend. I've been written this for Epoch Times many, many times. The inflation tends to come in waves. Our last big experience in the 1970s went in three waves. Each time the Fed thought they had conquered inflation, lowered interest rates, and kicked off another wave of inflation until it culminated in the late 1970s. So if you think about the wave that was kicked off with the quantitative easing in 2020, we've been through a really dramatic inflation over the last 4 years that is anywhere between, I don't know, depending on the good or service, it could be as high as 50%, but as low as 20%, but maybe overall it averages at about 25, maybe 30%. It's hard to say. But the problem is that when you look at monetary aggregates right now, they've now exceeded what was their previous peak from 3 years ago. And I'm just not sure that it's all been washed out yet. And all of the policy pressures in Washington are towards lower and lower rates, which is only going to lead to a more expansionary monetary policy. The reason for that policy pressure is, of course, financing the exorbitant debt, which is completely out of control. So I am not as confident, and today I have to say it rattled me a little bit. I don't want to live in a world with even with a 3% inflation target. I'd like to see it drop back down to what it has been historically, 2%. That would be really nice, and I'll just be much more comfortable when that day arrives. Hopefully it does arrive, as your guest predicts, later this year,
right,
or later in the spring.
Okay, so Michael, if we look at all the data up to this point, what has been the trajectory of inflation?
So it peaked in June of 2022 at 9%, 9.1%, continued downward, got stuck around 3, and then dropped down to 2.4. Now the last 4 or 5 months, it's inched back up again. For a number of things, but the underlying causes of inflation are being mitigated. The huge government deficit has caused a lot of inflation. President Trump knocked it from a little over 2 trillion per year to in fiscal 2025 down to 1.8 trillion. And it should continue to go down further as, although it's extremely difficult to cut government spending, as we're seeing. But President Trump is doing what he can to get government spending down. He's increased tax revenue from the tariffs, so the deficit should continue to go down. The other reasons we had inflation were extremely high energy prices, and those are coming down. If you bought gasoline recently, you probably paid a lot less this time than you did the last time or two when you bought. So energy prices are coming down. And during 2021 and 22, for some reason, the Federal Reserve kept expanding the money supply by through their bond buying program and purchasing a lot of the government debt. They've stopped that. And they kept interest rates near zero during that whole time period. Now, obviously, they've changed that too. I believe the interest rates today are too high. They're in a restrictive level. The federal funds rate up around 4% is restrictive. Most economists say if you keep it at 3.25, it's neutral. Anything less than that is stimulative. I think there's plenty of room for the Federal Reserve to cut interest rates. I think they should have cut them 50 basis points last time. They're likely going to cut them 25 basis points next week. I think that should be a 50 basis point cut. The jobs numbers were very weak. And for the last 2.5 years, they were overstated because we had someone in charge of the Bureau of Labor Statistics who didn't seem to understand how inferential statistics work. And she kept giving us numbers that were inflated. We need to stimulate the economy now. I'm not worried. I know my colleague here is worried somewhat, but I'm not worried about the inflation rate. I'm more worried about the low employment numbers and the low numbers of jobs that have been created really for the last 2.5 years.
Yeah.
Okay, so Jeffrey,
Yeah.
since he brought it up, interest rates, how do you think this latest report is going to affect the central bank's interest rate decision?
Well, I mean, just to make a really obvious point, the 3% inflation actually lowers the real interest rate, right? So in real terms, interest rates are not actually that high. Historically, they're still low in real terms. They're usually not expressed that way, but it's true. You have to factor in inflation when you consider the interest rate. So they're not high. And I think that right now is a very risky time to be cutting interest rates. As for the jobs numbers, yeah, what a disaster. We've been through 2 or 3 years of wacky, wild, insane jobs numbers that never made any sense. And we're hopefully going to see a little more reality introduced into the jobs numbers so we can get a better picture of where we are. You know, my concern is not just about energy prices, but grocery prices too, and beef prices. You're starting to see these strange inflationary pressures just pop up in very weird places. Politically, I think this is potentially very dangerous for Trump. And I really do think that people who wish this administration well need to get serious about this. Inflation could destroy this entire term if it comes back, and nobody knows for sure what's around the corner. But I just extreme caution right now in lowering interest rates. I think is warranted, especially given all the price pressures that are pertaining to particular goods as a result of the trade wars. Now, just to be clear, I don't think that Trump's trade policies have really contributed substantially to inflation. So contrary to what everybody in the New York Times says, I don't believe that. It's not really true yet, but nonetheless, the trade problems could mitigate against a relaxation of prices in certain sectors, and that's something to consider. So I really do think the Trump administration needs to prioritize keeping a lid on inflation right now, and unfortunately, that is inconsistent with continued pressure on the Federal Reserve to lower interest rates. I'd like to see them at this level Let the yield curve flow out very naturally. Let the Fed clean up its balance sheet once and for all, get on a normal track. And I think that'll give us the best prospects for fixing not only the job market, but economic growth generally.
All right, so Michael, we also got news today that an estimated 75 million Americans will get a 2.5 or rather 2.8% increase in monthly Social Security benefits. And of course, as you know, the Social Security cost of living adjustment is tied to the CPI report. So I want to ask you, does the real world experience of inflation for Americans at the grocery store match that of the official data? And how far will this 2.8% increase go at the grocery store?
Well, by the time the year is over, the next month or two, I think the inflation rate will probably end up the year right around that 2.8% figure. So if Social Security recipients get that 2.8% increase, it should balance out overall. However, there are certain things that people on fixed incomes purchase, and then people that are have closer to the median income purchase. So it depends on where the senior citizens are living and whether they have kind of a fixed payment there, if they have a home that they own. They're not going to worry about housing costs going up. Food prices are an issue. As was pointed out, beef prices are sky high. I went to buy beef last week, and I just couldn't believe the price. Now, much of that has to do with Trump cutting off imports from Brazil. Now he's trying to make it up with imports from Argentina. I'm not sure how the cattle ranchers in the U.S. will react to that. Not very, very positively. But people that are on fixed income, in order to stay even, they need an increase in what they get equal to the average inflation rate, which they're getting. So overall, it should not be that much of a burden to people on Social Security.
Okay, so Jeffrey, there's another thing I wanted your guys' comments on. The U.S. Trade Office now launching an investigation into China's compliance with the Phase 1 trade deal. What do you expect this investigation will find, Jeffrey?
I think it's going to find something really terrible. I mean, China has been involved in, as they say, stealing trade secrets for a very long time. This is not an unknown fact. I mean, what's unusual is that the Trump administration is trying to do something about it. Trade relationships with China continue to break down, and I don't really expect to see any real progress on that front. I think it's only going to get worse. And I'm concerned about that from the point of view of an American consumer in the short term. That could actually lead to some regrettable consequences for American consumers, and sad. On the other hand, something has to be done to reset this relationship with China. I don't think that anybody has any doubt about that.
Michael, final comments here.
China needs us far more than we need them. And if we continue to place high tariffs on their goods and they can't sell them to the US, they'll try to sell them around the world. There's not enough demand in the world to pick it up. We're at the advantage here. The problem that this investigation in 2019, President Trump signed a trade agreement with China that they agreed to buy so much things, mostly farm goods. And then they did in 2020. And then when the new administration got in, they stopped buying the goods, and the new administration didn't do anything about it. So now we're looking into it, and we're saying, look, China, you didn't live up to your agreement here, and they do have a history of not fully living up to all of their agreements. President Trump will be much firmer with them on these next agreements. The Chinese economy is not doing well. It's built a lot on debt. Most of the real estate expansion was on debt. They're having a lot of problems there, a lot of defaults. Their economy is slowing. We don't get, I don't think, accurate data on growth numbers from China, but the people I talk to seem to tell me that the Chinese economy is in very poor position, and they can't afford to lose all of the trade with the U.S. Much of the sanctions that we put on China did not affect prices in the U.S., meaning they absorbed the tariffs. They can't continue to operate and lose the sales to the U.S. So I think when Trump meets with Xi, I think next week or the week after, next week, I think you'll see some kind of an agreement come out of that, and it will favor the U.S. I don't know why China, out of the clear blue, started to do with these rare earth minerals, saying we're not going to sell them to everybody, you have to apply. But for us, everything was going along fairly well, from what I understand, until China, out of the blue, did that, and it upset the Trump administration. So they'll talk about that, and Trump has already started to look for other sources for those rare earth minerals, mining them here in the U.S., an agreement with Australia, an agreement with Ukraine. So we're less dependent in the long run with China. China needs to make a deal with us before too long, or they're really going to be hurting, in my opinion.
All right, gentlemen, I think we can leave it there for today's conversation. Really appreciate you guys coming on.
Sure.
Always my pleasure.
Nice to hear. Thank you.